You only have to pay taxes on your taxable income. So how do you reduce your taxable income, therefore reducing your tax bill without actually reducing the amount of money you have in your bank account? In today's episode, I'm going to be telling you about 5 different tax strategies that sound crazy illegal, but I promise you they aren't. And you're going to want to stay until the end because the last one is one that is used by many of the national touring race teams that immediately keeps cash in your pockets. Hi, my name is Liz Joyner and I'm a motorsports attorney. But even though I'm an attorney, I am not your attorney. Anything I am talking about today is just to be for educational purposes only. As always, before you implement any of these strategies I'm about to be talking about, make sure you speak with a CPA or accountant or someone that can talk to you about your unique circumstance to make sure that you actually qualify for these strategies and that you are implementing them correctly within your business. The first tax strategy that I'm going to discuss is one that I actually talked about in this episode, and that is to register an LLC or some other type of business entity. Now, since I've posted that video, I've had quite a few questions regarding how do you even start to do that? How do you register a business? How can I have a race team as a business? And so I've created this cheat sheet. I'm going to put the link below. It is completely free, but in this cheat sheet is going to walk you through how to start a business. But for those of you that are just joining us, registering your business like an LLC or some other type of entity is a great way to reduce your taxable income. If you take reasonable steps in order to create a profit, then instead of just using racing as a hobby, it can actually be converted into a business. But you have to take reasonable steps to make a profit. So for instance, racing in multiple races, selling merchandise, making content, just doing something to at least try to make more money than what your expenses are. And if you are a business, then you can deduct any of the ordinary and necessary business expenses and therefore reducing what your overall taxable income is. Now, the IRS defines ordinary expenses as anything that is expected for whatever your trade or your industry is. So particularly for race teams, what we're looking at is fuel, parts, entry fees, pit passes. Anything that has to do with racing is going to fall under that ordinary expense definition for the IRS. The IRS defines necessary expenses as anything that is helpful or appropriate for your business, not indispensable. So for instance, if you buy a new Longhorn, you don't have to prove to the IRS that you absolutely needed it. You just need to be able to show that it is something that is helpful for you to run your business. You can also deduct these expenses as business expenses even if you don't have an LLC. So I do want to make that clear. If you are a sole proprietor and you have business expenses related to your race team, then you can still, as long as it is ordinary and necessary business expenses, they can be deducted and they can reduce your overall tax liability. But having an LLC or some other type of registered entity opens other tax strategies that I'm going to be talking about here in just a minute. And so having an LLC itself, there's other advantages, which again, I also talk more in depth in this last video. So for instance, the next tax strategy that I'm going to discuss only applies if you have an LLC. And that is, if you are an LLC, you can elect to be taxed as what is called an S-Corp. So I have to take a couple steps back here. The IRS doesn't actually recognize LLCs. So if you are a single member LLC, meaning you are the only one that owns that business, you are taxed by the IRS as a sole proprietor. And if there are 2 or more members of that LLC, then you are actually taxed as a partnership. You can elect to be taxed as an S-Corp. It's just a little extra paperwork. Actually, it's free paperwork on the IRS website. So you can elect for your LLC to actually be taxed as this S-Corp. If you are an S-Corp, then what happens is any profits you make from the business, you have to pay yourself a reasonable salary on a portion of it. And then if you pay yourself a reasonable salary on a portion of it, then only that portion is subject to what is called self-employment taxes. So when you are a business owner, you are actually taxed kind of twice. So you have self-employment taxes on the profits of your business, and then when you file your tax return, you have your income tax. So what an S-Corp does is it reduces what your self-employment tax liability is. This strategy really only works if you have a pretty significant amount of profits that are coming in. Let's just say it's $50,000 that comes in. Then what you would do is you would run a portion of that through payroll, and you would actually get a W-2 like you would if you worked for another company. You would get a W-2 on the portion you ran through payroll. That is subject to self-employment. And then the rest of the profits that came from your company is only subject to that income tax liability. I'll create another video at some point that's really explaining the difference between the self-employment taxes and the income tax and how this all works with the LLCs and S-Corps. But for purposes of this video today, I just want to make it clear that there is tax advantages if you have an LLC of being taxed like an S-Corp. But make sure that you subscribe and you hit that notification bell so that when I do post that video, you receive the notification for it. The next tax strategy is actually one of my favorites, and this is called either the Augusta rule or the corporate rent rule. And under this rule, homeowners are allowed to rent out their home to their business. So as long as you have an S-Corp or you have an LLC that is owned by more than one person, so a partnership, then you as a homeowner can rent out your home up to 14 days in a year to your business as an ordinary and necessary business expense. And you as a homeowner, you do not need to claim this rental income on your income taxes, so you don't get taxed. So in this scenario, it is now a business expense for your race team, and it is tax-free for you. So this income just ends up being washed out. There's some limits to this, as you actually have to rent out your home to your business. So when would this possibly apply? So let's say you as a race team, you need to have monthly meetings, and your race shop is not located at your home. And so you decide that you're going to have these monthly meetings at your house. You would rent out your home to your business one day a month. Let's say it's for $12.50 because that's the going market rate if you were to rent out a conference center within your community. The business would then write you a check for that $12.50 a month, and you would receive that money. So again, now it is an ordinary necessary business expense, and it is deducted from your overall business. It is no longer considered profit, and it goes into your pocket, and so you're able to spend it as you will. That ends up being about $15,000 tax-free. There are some limits to this rule in the sense you need to actually rent out your home to your business. You can't just write yourself a check and say it's for rental income. It needs to be either an S-Corp or it needs to be a partnership. So you can't be a sole proprietor, and you cannot be a single owner to an LLC in order to use the Augusta rule. Last is that your business cannot operate out of your home. So if your primary residence, your home address is the business address and that's where it's operating out, you're not going to be able to rent out your home to your business because your business already operates there. So it does need to be separate. So like I said, if you have a race shop that's somewhere else, you can rent out your home for those meetings or for whatever you need to do. The fourth strategy is to pay your kids for work that they have actually performed, with washing the car, with assisting with making content, if you have any administrative duties, just crewing at the racetrack. But if you have any dependent children, you are able to deduct that expense. You can pay them as if they are contractors, and that ends up being an ordinary necessary business expense that gets deducted. It reduces your taxable income, and then that is money that goes to your children. If you own an LLC, then in 2023, you can pay your kids up to $13,850 for the year without them having to pay any self-employment or any income tax on it. So this ends up being completely tax-free money that is still assisting with your household. It is setting your children up for a good future. If you are a corporation, though, so like an LLC that has elected to be taxed like an S-Corp, then you do have to run any amount that you're paying your children, you have to run it through payroll, so they're going to actually get a paycheck, and they'll get a W-2 at the end of the year. And so in that scenario, they do end up paying FICA taxes or self-employment taxes. Those are all the deductions that you see on your pay stubs that you receive, but they do not need to pay income tax on it as long as it's under that $13,850. The last tax strategy that is used by dirt track racers all over the country is to register a holding company in Montana. And then this holding company will then own your toter home, your trailers, your trucks. So any of your vehicles or recreational vehicles will be owned by the Montana company. So again, why would you want to do this? Montana has very low registration fees. You can get a permanent license plate, and it can be a permanent registration, so you don't need to worry about renewing your registration every year. And the big one is there is no sales tax. So if there's no sales tax, that is immediate tax bill whenever you buy a new vehicle. Let's say it's a $150,000 toter home. And if there's a 7% sales tax that's imposed on that, that's $10,500. It is an immediate tax bill that you need to pay. If you have a Montana company, then that Montana company can own the toter home, and then that Montana company can then register the toter home in Montana, and you don't have to pay that $10,500 because there is no sales tax in Montana. There's also in Montana, there's no inspection or emission requirements for any vehicles that are registered there. So if you're in a state that requires emission testing or any type of inspection, then that's not going to apply if the Montana company is owning the vehicles. Now, I do want to have a caveat here in the sense that you still have to comply with whatever your local laws are. So if you are in a state in which requires certain registering, like if your vehicle is within the state for a certain period of time, even if it's owned by someone that doesn't reside here, like a Montana company does not reside in Florida, you might still have to register and pay sales tax within your state. So you have to make sure that you're still complying with your specific state. But if you are frequently traveling and you are a touring team and therefore your vehicles are very rarely within the same state, then this is definitely a strategy to at least look into to see whether or not you would qualify for it and it's something that you would be able to reap the benefits from. Now, again, I have provided a very high overview of 5 different tax strategies. And so make sure that you are meeting with an accountant or a CPA or someone to make sure before you implement any of these tax strategies that they actually apply to you. There's a lot of different rules and requirements for each one of these. And again, this is very high, like very broad overview on them, but at least lets you know that they are out there. So you can start that conversation to see whether or not this is something that would apply and you as a race team would be able to benefit from it. If you found this information helpful, it is so helpful to us if you would hit that like button. Also, if you would subscribe and hit the notification bell so that you are notified the next time that we post a video. But until next time, we think that you would enjoy one of these 2 videos.